Well, not quite nearly the zone of resistance. There's still some headroom. It's about 0.5% higher.
Markets are firmly higher, so it's a good start to the trading week. The Nifty, the Sensex are up close to about 0.5%.
The markets, we did fall sharply from the day's high.
The broader market is still doing quite well. Advanced decline is still well in favor of the advances. And a lot of stocks have done well.
The day is ending absolutely flat on the Nifty. Not even a point up or down. The Sensex up just about 4.
Markets rise with Asia and ebb with Europe, ending almost flat from Friday's levels. Midcap index closes at a record high of 27,500. Market breadth favors advancing stocks.
Holding companies Equitas and Ujjivan hit 20% circuit limits after RBI allowed them to reverse merge their respective small finance bank businesses. The bankers see SEBI's nod to waive lock-in for the holding company shareholders is crucial for the reverse merger to take place.
Federal Bank is up 5% after Reserve Bank approves a 3-year term for CEO Shyam Srinivasan. Bank Nifty itself closes 127 points higher and is one of the best performing sectors, led by ICICI and Kotak banks.
Textile stocks soar on hopes of a PLI scheme will be announced shortly. Niti Aayog Vice Chairman tells CNBC-TV18 that the PLI is on the anvil and will be rolled out soon. Textile companies say concentrating on man-made fiber is good, but cotton also needs to be included in the scheme.
Inquiries and transactions in residential real estate was higher in Q1 than in Q4 last year, says Puravankara, while industry bodies and think tanks say demand is picking up more in the affordable segment, driven by low home loan rates. Real estate stocks end higher. Well, those are the top 5 headlines from Dalal Street on a day when the markets failed to live up to early promise. Welcome to Markets Today, the show where we will tell you all that happened in those 6 hours of trading in 5 headlines. I'm Lata Venkatesh, with me my colleague Prashant Nair. Hi, Prashant.
Lata, hi. I mean, almost unchanged from Friday's close. Not even a point on the Nifty. 0.8 points to be precise. But, you know, beneath the surface, there is a lot which went on. It started on a pretty good note, and then the market corrected mid-session, never to really recover. It's a packed show. We'll tell you what happened. Let me just quickly give you a teaser of what's lined up in terms of their opinion. Nilesh Shah, Managing Director of Kotak Mahindra Asset Management Company, on markets from here. Nitin Chugh, Managing Director and CEO of Ujjivan Small Finance Bank, and P.N. Vasudevan, Managing Director and CEO of Equitas Small Finance Bank. Textile stocks were all higher. We have Kulin Lalbhai of Arvind Fashions and Manoj Kumar Patodia of TexPro Sil. We also have voices from the real estate sector. Abhishek Kapoor of Puravankara, Anshuman Magazine of CBRE South Asia, and Gulam Zia of Knight Frank on what's happening there. Real estate index up almost 4%. Before we get to all of their opinion, let's quickly wrap up the day for you. Lata.
Well, actually, the day started on a positive note in the sense that the over the weekend Wall Street cues were very strong. It wasn't just that all the 3 Wall Street indexes ended at record highs. The bond yields also moved higher, and to that extent removed the scare that growth is likely to be less than earlier anticipated. There was almost a consensus that 1.25, which the US 10-year touched, was probably technical and not indicative of any serious slowdown in global economy or US economy. With that, one expected that Asia will catch the growth bug. It did. But after the morning lifting of all boats by Asia, Europe did not quite perform. Europe has already risen. Europe had a strong Friday, so it had no reason to follow up on that strong rally. And they are also awaiting inflation data from the United States later this week. And for whatever reason, we didn't have a strong Europe, and therefore the Indian bulls also started selling out. But within that, you have to admit, of course, you have to give India is also worried about the emerging market basket being more impacted by the Delta variant, COVID worries, a large part of Asia, and even developed markets like Japan. Shutting down large parts. So that worry was always bound to, lead to profit taking in India as well. Indian COVID numbers, by the way, increased a bit. Our positivity rate has been above 2% for the past 2 days. But I think that still doesn't disturb the broader health of the market. The small cap index ended at 0.6% higher. The mid caps, as you were saying, have ended about 0.5% higher. So overall, 3 stocks in the green for 2 in the red. And all the economy facing stocks, according to me, looked like doing well. But you tell us.
Bottom up in terms of stocks, real estate as a pack did the best. Now that is definitely economy facing. Small caps and mid caps, as you said, and the private bank index was up the most. So this is pockets where there was maximum green. What was down was IT, which sold off a little bit. Metals and energy, those are 2 other pockets which did see some profit taking. Gains coming through on the Nifty in cement names, Ultratech, Grasim and Shree Cements, top 3 gains on the Nifty. Losses there coming through in mostly old economy. Adani Ports, BPCL, Tata Steel, there was some profit taking, and IT as well. Okay, let's come to the broader market space. So India Bulls Real Estate, Puravankara, big gains, and real estate has been a theme today. Force Motors looked up 19%, had a great week last week as well. Equitas Bank, Ujjivan, and we will discuss more about the story. Shilpa Medicare, KRBL, SIS, it continues its run from last week. Shankara Buildcon, broking companies like Edelweiss, Angel Broking. There was Aster DM, Kaya. Kaya again, I think after a long time it started performing this month. We've got what else? DB Corp, which was up on very strong volumes. GNA Axles, Wheels India, Harrison's Malayalam. So a spattering of names from all over the place. And then textile is a pack, right? Look at this. Keytex was up, limit up 20%. Zodiac Clothing, Jindal Worldwide. A lot of them are not textile names, but textile apparel names. Arvind, Indian Terrain, even something like a Page Industries, Gokuldas Exports, Himmat Singh, Bombay Dyeing, and all of them had pretty decent volumes as well.
We will flesh out the textile theme a little more, but Kitex perhaps will hit home rather hard for you and me. They're pulled out of Kerala. Okay, let's get to expert opinion. We caught up with Nilesh Shah, the Managing Director at Kotak Mahindra AMC, for his outlook on the market and his sectoral views. Hear about.
Market is ignoring short-term pain of COVID-19 related effects for longer-term gain of corporate profitability. In June 20, NSE 500 companies reported about 32,000 crore profit. It went to 1,76,000 crore in September against all expectation. Went to 2,09,000 crore in December 20 against all expectations. And in the month of March, the quarter of March 21, it's expected to be roughly about 2,11,000, 2,12,000 crore. So people are expecting similar kind of profitability growth in corporate India, especially becoming bigger as they are gaining market share from unorganized sector, and they are in a better position to survive the downturn. In automobile space, we are seeing chip shortages are likely to cast a longer shadow. Raw material inflation has hit them, and though they have taken price rise, those price increases are not sufficient to cover the margin. For them, volume expansion is extremely critical. And more importantly, we don't even know whether those price increases will have an impact on volume or not. So right now, auto sector is, at best, I can call it an accumulation zone. You pick up very, very selectively with very, very tight price control.
All right, Nilesh Shah of Kotak there. Now, Avenue Supermarts closed more than 1% lower after it reported a disappointing set of earnings for the first quarter. Gross margins came in at a 22-quarter low. Mangalam is here with the key highlights from the numbers. Mangalam.
That's correct. So Avenue Supermarts is actually underperforming in trade today on the back of a margin miss that the company reported in their first quarter numbers. The revenues were largely in line with the street expectations, 5180 crores versus our poll of close to around 5150 odd crores. That's partly also aided by the fact that the company had given its revenue numbers a week ago as a cheat sheet. But in terms of EBITDA, 224 crores, much below expectations of 285 crores. And that's led by gross margins, which are at the lowest level ever since the company listed. Overall, EBITDA margins at 4.3%, also below street expectations, and that's caused a miss in the bottom line at 95 crores versus a poll of 170 crores. Year on year, of course, has been a big jump because of a favorable base, but quarter on quarter, the impact of the second wave is visible, with the revenues declining 30%, net profit declining 77%. While things are opening up gradually, the management says that it takes 45 days of unhindered operations for the company to reach pre-COVID sales in each store. The stock, before going into numbers, was at a record high, trading at 88 times FY23 earnings. Wasn't particularly cheap, in fact, on the more expensive side as per its historic valuations as well, and which is why we've seen a couple of brokerage cuts come by in terms of EPS estimates. But everyone is largely positive about the long-term prospects of the company, which is why dips on stocks like Avenue Supermarts are usually shallow.
I take your point entirely, Mangalam. Thank you for that. Of course, it's trading at 88 times, as you point out. But, you know, they have had the courage to go ahead and open stores, which speaks of the management's confidence that business is going to come back. With that, we come to the second headline from the street. Ujjivan and Equitas, the holding companies, hit 20% circuit limit after Reserve Bank permitted small finance banks to apply for reverse merger with their holding companies, which these two are, Equitas and Ujjivan. Let's go to Abhishek Kothari to first understand what the Reserve Bank announcement means. Abhishek.
RBI has, permitted small finance banks to apply for reverse merger, that is for Equitas as well as Ujjivan Small Finance. So if reverse merger is approved, the holding company discount that these companies are getting will significantly narrow. Currently, the holding company discount as of Friday's closing price is about 35.3% for Equitas, Ujjivan at 43.5%, and IDFC Limited at about 44.5%. Now, the key hurdles for SFB's reverse merger could be the fact that promoter holding is very high. For Equitas, it's about 82%, and for Ujjivan, it's about 83.3%. So SEBI regulation with respect to promoter holding will be seen closely because if SEBI's exemption does not come in, the holdcos may have to wait for a couple of years before reverse merging. And this may also lead to, a promoter holding breach that can happen, given the fact that post September 21, Equitas has to reduce it to about 40% and to 40% for Ujjivan post 31st Jan 2022. IDFC Limited, on the other hand, holds about 100% in their AMC business, which they need to sell before reverse merger. Back to you.
Abhishek, thanks very much for that. We actually spoke with Nitin Chugh, Managing Director of Ujjivan Small Finance Bank, and P.N. Vasudevan, Managing Director and CEO of Equitas Small Finance Bank, to understand what the steps will mean for their businesses. Listen in.
The Association for Small Finance Banks has received this letter. In that letter, they've said that we can apply 3 months prior to completing 5 years, which would mean that sometime in end October, we can indeed apply to RBI. Now, the SEBI condition really is the promoter shareholding of 20% for 3 years after listing. Now, that is something which is procedural in nature, according to us, and we will have to go through that, asking for an exemption from SEBI, which is the way it works. However, I think procedurally, it might require us to go to SEBI after the RBI issues us the information, right?
We have been seeking approval from RBI to allow us to reverse merge the holdco with a bank because the holdco and the bank principally carry out the same business, which is the underlying business of the bank. But we had to create the holdco only to ensure certain compliance from a promoter perspective. And the holdco, if you look at it, that does not have a promoter behind it. So it's a widely held, publicly held company. So we were always seeking RBI approval to say that, since there is no individual promoter behind the holdco, can they allow us to merge the holdco with a bank? But technically it was not possible, so we were not getting the approval. Now finally RBI said we are permitted to apply. Actually, at the end of 5 years we could have applied. As per RBI guidelines, we could apply after 5 years completion, but we are seeking to apply prior to that so that we can save some time.
Of course, you need SEBI as well to approve the merger, to allow the promoters of the holding company to not have a lock-in. Otherwise, it may fall through, is what both Ujjivan and Equitas told us. With that, let's come to the third headline. Federal Bank has gained almost 4% after the Reserve Bank approved a 3-year term for its CEO, Shyam Srinivasan. Well, why is this important? Because earlier, a few years back or maybe 2 years back when Federal applied, Shyam Srinivasan got a 1-year extension. And even this year, several other peer banks like DCB and RBL have been able to get only a 1-year extension from the Reserve Bank. So the chatter among the banking circles is that Federal must have been told to set something right in the previous occasion, and it has complied very well with Reserve Bank. Reserve Bank is impressed, and that is why the 3-year term has been granted. You know, a green tick from the regulator is always something which enthuses investors, which increases their confidence, and that may explain this 5% rise in Federal shares today. The other thing that happened in Federal Bank also was an AGM on Friday where IFC, International Finance Corporation's bid to increase stake was approved by the AGM. That money will hit the till sometime this week, which will improve Federal's chances of growth, pro-growth policies. All that perhaps have helped Federal shares to rise 5%.
Absolutely. Let's move on to a CNBC-TV18 exclusive now. We learn from sources that the KV Kamath-led expert committee on loan restructuring is set to submit its finding to the Reserve Bank soon. My colleague Ritu Singh is joining in with more details on this. Ritu.
That's right, we've been given to understand that the KV Kamath-led expert committee on loan restructuring is set to submit its final findings on corporate restructuring to the Reserve Bank of India very soon. And according to the report, banks referred only 9 large corporate accounts for restructuring, all of which were approved by the Kamath committee. These 9 companies include 3 future group companies, including Future Retail, Future Enterprises and Future Lifestyle. There's also Patel Engineering and Metals and Minerals Trading Corporation. There's Shapoorji Pallonji Group, Hinduja National Power, ACB India and Ambience Developers, and the total loans outstanding across all of these 9 companies is at about 58,800 crore rupees. Remember, the Kamath committee was set up to clear restructuring proposals which involved more than 1,500 crores of debt, and the deadline to implement restructuring has closed now as of 30th of June. Of course, the window to restructure retail and MSME loans has been extended, so those final figures will only be known later. But as per RBI's Financial Stability Report, only 0.9% of the total banking loans were restructured as of the 31st of March. The reason for the low restructuring, according to the bankers, is several. One, of course, corporates wanted to stay away from the restructuring tag because it may impact their ratings. They could also make do with the additional credit facilities that were extended, and banks on their own part have also been conservative in extending restructuring to large corporates.
All right, thanks a lot for that, Ritu. And the other stock in focus was Metropolis Health. It slipped 4% on the company terminating Ganeshan High-Tech's acquisition. Ekta Batra is here to tell us about this story. Ekta.
Well, yes, the news with regards to Metropolis is that the acquisition of Ganeshan High-Tech has not gone through. It has been terminated. Now, according to the company, there have been delays in the completion of the seller's obligations under the share purchase agreement or the SPA, and there was no communication from the sellers also with the letter which was issued on 5th July by Metropolis. Now, just to give you a background on the deal, the board had approved the acquisition of the South-based laboratory chain on Jan 17, 2021. The acquisition was a combination of cash and equity, which was worth around 617 to 620 odd crores, with a cash component of around 510 odd crores. Now, the street was largely expecting that there could be a possible termination of the deal because the deal had already been delayed by a couple of months in terms of closure. However, the positive for Metropolis would have been that it would have strengthened the southern market for Metropolis. It's around 25% of their revenues, also in a time where there is competition increasing in the diagnostic space. However, the positive for Metropolis is that it's a zero debt company, and it would have been taking on around 300 crores of debt, in fact, to fund this acquisition.
All right, Ekta, thanks very much for that. We'll take a very quick break here. Our first on the show, we are back quickly. More headlines, more opinion on the other side. Welcome back. You're with us here on Markets Today. We're running you through what happened during the course of the day. In case you missed the market action, well, strong open, and then there was a sell-off, flat close absolutely on the Nifty. We ran through 3 of the top stories which mattered. Here's the 4th today. Textile stocks soared on hopes of a PLI scheme, which is expected to be announced shortly. Niti Aayog Vice Chairman has told CNBC-TV18 that the PLI scheme is on the anvil and will be rolled out soon. Here is a slice of that conversation that we had earlier.
The textile bit, it's very much on the anvil. It's been under discussion for a while now. I'm not completely aware of what's holding it back. There is one scheme which the government is very keen to push through. It will be done the sooner the better. I know for a matter that we wanted to also encourage under that scheme technical textiles and man-made fibers, man-made fiber-based garment exports, because that's, I think, now 80% of the world market.
Okay. We also spoke with Arvind Fashion's director Kulin Lalbhai and Manoj Kumar Patodia, the chairman of Texprosil, for their expectations from this production-linked incentive scheme, or the PLI scheme for the textile sector. There is still a lot of to and fro in the industry itself on whether it should be entirely man-made fiber or whether it should also include cotton. Some sections want cotton to be included. Listen.
We do expect the final structure of the scheme to come out over the next few weeks or months. On the garmenting side, we do need to scale up. And if PLI were to include the garments tech sector and some of the critical areas where there are bottlenecks even outside these two sectors, it would be welcome. But I think it's always something where you have to weigh in the amount of resources available.
I think because we have a lot of fragmented industries, so it's very important that this scheme should take that into account. And also further, the PLI scheme, as in cotton, I can tell you that there is a good possibility to increase the investments in the cotton sector, especially in the knitted fabric and technical textiles, also in cotton and in MMF, which can give a very big flip to the scheme.
Okay, the market awaits that PLI and we'll of course, track it when it comes. The fifth headline then today, real estate stocks were buzzing in trade following upbeat first quarter commentary. And the commentary has generally been about big year-on-year improvement. Earlier in the day, we spoke with Abhishek Kapoor, the COO of the residential business at Puravankara, Anshuman Magazine, the chairman and managing director at CBRE South Asia, and Gulam Zia, the executive director at Knight Frank, who told us about their outlook for the real estate sector as India recovers from the second wave of COVID-19. Listening.
When you look at overall market, the pricing appreciation may look lesser because obviously there are players who are stressed or who are in the middle of a cycle where they need cash flows and therefore there may be some discounting. But I think from customers' point of view as well, they have started realizing that the developers who are reliable and who are large, organized, structured brands are the ones they will go with even if it is higher pricing, and they're willing to pay their higher pricing.
We have seen better movement in luxury, but largely the demand has been affordable and segment. And one of the main reasons is I feel is because of low interest rates. I think that is playing a big positive role. And prices have been quite flat over many years.
In last 3 months, the kind of new launches we have seen for last year and a half, we haven't seen. In fact, at least in case of Mumbai and Maharashtra, where pre-COVID there were a couple of issues related to the DCPR, the development control regulations, etc. Those clarity coming in, we are actually looking at the new launches, which are almost about equivalent to what we had pre-COVID first wave.
Okay, so that was some very optimistic statements coming in from the think tank of the real estate sector. Separately, sources told CNBC-TV18 that the cabinet has cleared the plan for the IPO, the initial public offer of LIC, and the listing is proposed by March 2022. My colleague Sapna Das, who has been following this story very closely, is joining us with the exclusive details. Sapna.
Well, it seems that the LIC IPO plan is on the fast track. We are given to understand that last week itself, probably the cabinet has given its nod for the listing of the corporation. Two aspects over there. One, of course, the pricing band as well as the quantum to be divested. That will be decided by the ministerial panel headed by the finance minister on disinvestment. That call will be taken by the AM, basically. And the proposal is to get the corporation listed by March, definitely. I mean, before the financial year ends. That, of course, is on expected lines again because this was a budget announcement, and looking at the massive disinvestment target set out for FY22 as well, LIC listing will be probably very important in terms of meeting the disinvestment target as well. Of course, the cabinet approval earlier was that government should offload around 25% of course in tranches. So this year's tranche will be critical, not just in terms of meeting that divestment target, but also testing the market and trying to understand what could be the possible response from the market. In the meanwhile, LIC itself is working on the embedded value, which will be most critical in deciding the pricing band and how much to be divested, improving internal efficiency, and also a bit of product restructuring. We may be hearing some more on that front in the coming time.
Okay, thank you very much for that, Sapna. So that was the best of the secondary market and the primary market news today. Thank you very much for joining us.
Thanks for watching. More coming up after a quick break.